What if I told you that the United States is quietly accumulating the kind of financial time bomb that makes the 2008 mortgage crisis look like a minor correction? What if the crisis that's building right now could be not just bad, but potentially catastrophic on a scale we've never seen before? Sit back, take a deep breath, and prepare yourself for an uncomfortable journey through the data, the warnings, and the stark realities that suggest 2026 could bring an economic collapse far worse than the Great Recession that wiped out $22 trillion in global wealth 16 years ago. Because tonight we're going to answer a question that economists, investors, and world leaders are increasingly asking in private, even if few will say it publicly on camera. Why is 2026 poised to deliver a financial crisis that could dwarf everything we've seen before? Let's begin with the cold, hard numbers, because numbers don't lie, and these numbers are screaming at us. The United States national debt has now surpassed $38.4 trillion, according to the latest Senate Joint Economic Committee data. That's not just a number, that's a figure that translates to approximately $290,000 per American household. The debt increased by $2.23 trillion in just one single year, averaging $6.12 billion per day. Let me repeat that. $6 billion added to the national debt every single day, 365 days a year. And if current trends continue, the Congressional Budget Office projects this debt will surge past $40 trillion by the end of 2026. But here's what really keeps economists up at night. Interest payments on this debt have now exceeded $1 trillion annually. That's not money going to roads, schools, or healthcare. That's pure interest. And it's already the second largest line item in the federal budget, second only to Social Security. The Federal Reserve's own analysis shows that interest payments consumed approximately $970 billion in fiscal year 2025 alone, representing 3.2% of GDP and a staggering 14% of all federal outlays. Compare this to 2008. In the months leading up to the financial crisis, total U.S. public debt stood at approximately $9 trillion. Today, it sits at nearly $38 trillion and climbing. The ratio of debt to GDP, a key measure of a nation's ability to service its obligations, has now crossed the 100% threshold. In simple terms, the United States now owes more than it produces in an entire year. Now consider this. During the 2008 crisis, the federal government had room to borrow, to spend, to bail out banks and stimulate the economy. The national debt to GDP ratio was roughly 64% at the start of 2008. And even after the massive bailouts and stimulus packages, it rose to about 80% by 2010. Today, that ratio is already over 100%, and there's precious little room left to maneuver. The Bipartisan Policy Center warns that failure to address the debt limit in a timely manner would likely have catastrophic consequences for global financial markets and Americans across the country. We saw what happened in 2011 when Standard & Poor's downgraded the United States credit rating for the first time in history. Stock markets plummeted, consumer confidence collapsed. The Dow Jones Industrial Average dropped over 2,000 points in a single week. And that was when the debt was less than half of what it is today. Now let's talk about inflation, because here's where the Federal Reserve finds itself trapped in an economic straitjacket that could make everything else worse. After peaking in 2022, inflation remains stubbornly elevated, hovering between 4 and 5% in late 2025, according to multiple economic analyses. This isn't the transitory phenomenon that some policymakers initially predicted. This is persistent, sticky inflation that refuses to die and is creating an impossible dilemma for central bankers. The Federal Reserve finds itself caught between a rock and a hard place. If they cut interest rates to help a softening labor market, They risk reigniting inflation and losing the credibility they've fought so hard to regain. If they raise rates to curb inflation, they risk crushing economic growth, triggering layoffs, and potentially causing the very recession they're trying to avoid. Some economists are now using a word that hasn't been common in policy discussions for decades: stagflation. Consider the December 2025 Federal Open Market Committee meeting. The Fed cut their policy interest rate by 0.25%, but signaled a measured, cautious approach to future policy changes. Federal Reserve officials now estimate just a single interest rate cut in 2026, with the federal funds rate expected to remain in the 3.50 to 3.75% range. Markets that had been hoping for more aggressive easing are being forced to recalibrate their expectations. The problem is that interest costs on the national debt are inversely sensitive to Fed policy. When rates rise, interest costs explode. When rates fall, there's some relief, but only if inflation allows those cuts to happen. The Brookings Institution recently noted that the federal government does spend a lot on interest, and the arithmetic is brutal. Every percentage point increase in interest rates adds roughly $300 billion to annual interest payments on the national debt. Here's the nightmare scenario that keeps Fed officials up at night. What if inflation remains elevated, forcing the Fed to keep rates higher for longer, while at the same time economic growth slows or reverses? You get stagnation with inflation, the worst of all possible worlds, and the policy tools available to fight it become dangerously limited. Now, I want to draw your attention to something that most mainstream news outlets are barely mentioning, but that sophisticated investors and financial analysts are watching with growing alarm: the massive wave of refinancing that must happen in 2026. During the pandemic, when interest rates plummeted to near zero levels, the U.S. government issued trillions of dollars of short and medium-term debt at historically low rates. Those were the 0.8% 5-year notes, the 1.5% 7-year bonds, the debt that looked like free money at the time. All of that debt is now coming due, and it must be refinanced at today's much higher rates. The Congressional Budget Office projects that interest payments will consume an ever-increasing share of the federal budget in coming years, precisely because of this refinancing reality. When pandemic-era debt that was issued at 0.8% has to be rolled over at 4% or higher, the interest expense roughly quintuples for every dollar that matures. But the refinancing challenge isn't limited to government debt. The commercial real estate sector faces an even more immediate crisis. According to multiple industry analyses, approximately $936 billion to $1.26 trillion in commercial real estate loans are slated to mature in 2026. Most of these loans originated in the mid-2010s, when rates averaged considerably lower than today's levels. TREP, one of the leading commercial real estate analytics firms, calls 2026 a sorting year for the sector. Lenders are active again, but only for deals that meet stringent new criteria. Delinquency rates for office properties have already climbed to 10.4%, and that's before the full impact of the maturity wall hits. When property owners can't refinance at rates that make their deals work, defaults will rise, property values will fall, and regional banks with heavy commercial real estate exposure will find themselves in deep trouble. Recall what happened in 2008. The crisis started in one sector, subprime mortgages, and then spread to the broader financial system through exposures that nobody had properly accounted for. Today, commercial real estate could serve a similar function, except that regional banks are even more vulnerable now than they were then, having learned all the wrong lessons from the last crisis. Let's turn to Wall Street, where the party has been going on for years, and where a reckoning may be approaching faster than many investors want to believe. The S&P 500 gained 16.4% in 2025, building on gains from previous years. But here's what's troubling. This rally has been increasingly concentrated in a handful of technology companies, particularly those associated with artificial intelligence. NVIDIA, Alphabet, Broadcom, and Microsoft contributed the most to the index's gains, while broader market participation has been more limited. According to a recent report, 68% of CEOs say their companies plan to spend more money on AI in 2026. But here's the catch. Less than half of AI projects are actually delivering positive returns. We've seen this movie before. During the dot-com boom, companies could raise billions of dollars on the promise of future growth, even when they had no revenue, no profits, and often no viable business model. The crash that followed wiped out $5 trillion in market value. The Guardian recently warned that the longer the period between crises, the greater the complacency. That complacency is pushing share prices ever higher, driven by fear of missing out rather than fundamentals. A Deutsche Bank poll found that 57% of institutional clients rank a bursting tech or AI bubble among the top 3 risks for 2026. These are the professionals who manage other people's money for a living, and they're worried. Reuters reported that global investors will actively seek opportunities in undervalued pockets of financial markets as growing concerns over an AI bubble cause them to look beyond the tech sector. This is Wall Street's way of saying, we're getting nervous about the concentration of risk in a few stocks, and we're looking for the exits. If the AI bubble bursts, the damage won't be contained to technology companies. The broad market indices are now so heavily weighted toward these companies that a 30% correction in tech could produce a 15% or larger decline in the S&P 500. And in a world where pension funds, 401k accounts, and insurance portfolios are all indexed to these benchmarks, the pain would be felt by ordinary Americans who have nothing to do with AI speculation. Now, I want to introduce you to a term you may not have heard before, but one that could determine whether 2026 brings a mild recession or a full-scale financial collapse: private credit. Since the 2008 crisis, traditional banks have faced strict regulations designed to prevent the kind of reckless lending that contributed to the mortgage meltdown. Capital requirements are higher, risk management is more sophisticated, and the banking system, while not perfect, is arguably more resilient than it was 17 years ago. But here's what the regulators didn't account for: the explosion of the shadow banking system. Global assets in the shadow banking sector have crossed the $250 trillion mark for the first time, according to Bloomberg, fueling fears of mounting systemic risk. Private credit has exploded since 2008, and it's now a $1 trillion plus market that operates largely outside the regulatory framework that governs traditional banks. The Guardian reported that significant defaults in the private credit industry could ripple out to the wider financial system, including traditional banks. Private credit funds have been aggressively lending to companies that traditional banks have become more cautious about, often at higher interest rates and with looser underwriting standards. And because these funds operate outside the traditional banking system, there's no deposit insurance, no lender of last resort, and limited transparency. Moody's analysis shows that U.S. banks' private credit loan exposure has reached nearly $300 billion. This means that traditional banks have significant exposure to the same risks they're supposedly avoiding by steering clear of direct private credit lending. Senator Elizabeth Warren and other lawmakers have called on banking regulators to take immediate action to address cracks in credit markets. They've pointed to the potential for contagion. If borrowers begin defaulting widely on private credit loans, the losses would flow through to banks, to money market funds, to insurance companies, and potentially to the broader financial system. The IMF has added its voice to the concerns, noting that non-banks can transmit risk to the financial system through many channels, including private credit, real estate, and crypto assets. The shadow banking system has become so large and so interconnected that a blow-up in private credit could trigger the kind of cascading failures that characterized the 2008 crisis. Now, let's talk about who is buying all this debt, because this is a story that should concern every American. For decades, the United States has enjoyed an extraordinary privilege, the ability to borrow enormous sums of money at relatively low interest rates, much of it from foreign investors. This is the so-called exorbitant privilege of having the world's reserve currency. But that privilege is being tested in ways that could have profound consequences. Japan remains the largest foreign holder of U.S. Treasuries, with holdings around $1.2 trillion according to the latest Treasury data. But Japan's capacity to continue buying is limited by domestic financial pressures and high currency hedging costs that effectively eliminate the yield advantage of U.S. Treasuries. When Japanese investors buy dollar-denominated bonds, they face currency risk that can wipe out the interest rate differential, making U.S. debt less attractive than it appears. China's relationship with U.S. Treasuries is more troubling. According to Bloomberg's analysis, China's stockpile of treasuries dropped to $688.7 billion in October 2025, the lowest level since 2008. That's a reduction of over 40% from its peak holdings. China has been diversifying into gold and other assets, reducing its reliance on dollar-denominated securities as part of a longer-term strategic shift. And it's not just China. Oil exporters, once automatic buyers of U.S. Treasuries through the reinvestment of petrodollars, are also diversifying their investments. The petrodollar system that has supported dollar dominance for decades is showing signs of stress. The implications are serious. If foreign demand for U.S. Treasuries continues to weaken, the United States will have to offer higher interest rates to attract buyers. Higher interest rates mean higher interest payments on the national debt, which means less money for other priorities, which means either higher taxes or more borrowing. It's a vicious cycle that could spiral out of control. Which brings us to the broader question of the dollar's role as the world's reserve currency. The Federal Reserve's 2025 edition of the International Role of the U.S. dollar shows that the dollar comprised 58% of disclosed global official foreign reserves in 2024. That sounds dominant until you look at the trend. According to IMF data, the dollar's share in global reserves has fallen from 71% in 1999 to approximately 56.3% in mid-2025, the lowest level in 30 years. Think about that. In just 25 years, the dollar has lost roughly 15 percentage points of its share in global reserves. And the pace of decline appears to be accelerating. JP Morgan's analysis of de-dollarization trends notes that the dollar's reserve currency status reduces interest on U.S. borrowing and increases the volume of national debt the country can sustain. A loss of that status would fundamentally change the arithmetic of American debt. The implications go beyond interest rates. The ability to borrow in one's own currency is a superpower that the United States has taken for granted. If foreign investors begin to question the dollar's stability, the United States would face the same challenges that emerging markets face: currency depreciation, capital flight, and higher borrowing costs. The experience of countries like Argentina, Turkey, or Egypt when they lost access to foreign capital should serve as a warning of what's possible. G20 experts have called for support of de-dollarization of the global economy, arguing that reducing reliance on the dollar could limit risks and support green transitions. Whether or not you agree with the policy prescriptions, the fact that such discussions are happening at the highest levels of global economic governance signals that the dollar's dominance is no longer taken for granted. So far, we've talked about debt, inflation, bubbles, and global finance. But let's not forget the foundation of the American economy, the consumer. Consumer spending accounts for approximately 70% of U.S. GDP, and here the signs of stress are becoming increasingly visible. The Conference Board and other economic research firms have noted that consumer confidence has weakened as affordability becomes an increasingly acute challenge. Declining full-time employment and flat real wage growth suggest consumers are feeling the pinch, a trend often associated with incoming recessions. Recent polls found a growing share of Americans expect a downturn by 2026. One survey noted that 32% of consumers foresee their finances worsening next year. While not a formal economic forecast, such sentiment can become self-fulfilling. If consumers believe hard times are coming, they save more and spend less, accelerating the very downturn they fear. The labor market, which has been surprisingly resilient for several years, is showing signs of softening. The Federal Reserve's December 2025 economic projections showed unemployment expected to rise from current levels to 4.4% in 2026. Some private forecasts are more pessimistic, suggesting that the combination of higher interest rates, weaker consumer demand, and credit tightening could produce a more significant slowdown in hiring. When consumers pull back, businesses suffer. When businesses suffer, they lay off workers. When workers lose their jobs, they can't spend. This is the feedback loop that turns a mild slowdown into a recession, and a recession into something worse. Now, let's talk about Washington, D.C., because the political dysfunction in the nation's capital adds an additional layer of risk that didn't exist in 2008. The 2025 government shutdown reached 35 days, eclipsing the 34-day shutdown in 2018-2019 and becoming the longest in U.S. history. After 43 days, the shutdown ended on November 12th, but not before doing measurable damage to economic growth. The Congressional Budget Office estimated that each week of a government shutdown reduces GDP growth by roughly 0.1 to 0.2 percentage points. But the shutdown was just a preview. The debt ceiling was raised by $5 trillion to $41.1 trillion in July 2025, according to Congress.gov, providing temporary relief. However, the Bipartisan Policy Center warns that failure to extend the debt limit in a timely manner would likely have catastrophic consequences for global financial markets and Americans across the country. Government shutdowns and debt ceiling standoffs have become routine features of American political life, but they shouldn't be. Every time Congress flirted with default, markets experienced volatility. Every shutdown reduced economic output, and the cumulative effect of these self-inflicted wounds adds up to real economic damage. The Congressional Research Service notes that debt held by the public was $30.1 trillion as of mid-2025, with the difference between that and the total debt figure representing intragovernmental holdings, primarily trust funds like Social Security. This technical distinction matters for understanding the true burden of debt, but it doesn't change the fundamental arithmetic. The United States is borrowing money faster than it can pay it back, and political gridlock makes it harder to address the problem. Let's step back from the domestic economic picture and look at the global environment, because the geopolitical risks facing the world in 2026 add another dimension of danger. The Stimson Center's analysis of top global risks for 2026 highlights multiple flashpoints, including the ongoing conflict between Russia and NATO, tensions in the South China Sea, and the continuing war in Ukraine. These aren't just humanitarian crises, they're economic shocks that can ripple through global markets in unpredictable ways. The Eurasia Group's risk analysis identifies the most dangerous front in Europe, shifting from the trenches in Donetsk to the hybrid war between Russia and NATO. This represents a new kind of conflict that doesn't fit traditional economic models and could produce surprises. The UN's World Economic Situation and Prospects 2026 report warns that in the European Union, economic growth is forecast at 1.3% in 2026, down from 1.5% in 2025, as higher U.S. tariffs and ongoing geopolitical tensions take their toll. Bloomberg's analysis of risks for global trade notes that global trade was resilient in 2025 amid rising tariffs, but the consequences await companies and consumers next year. The Stimson Center specifically calls out Trump's tariffs and Chinese manufacturing overcapacity as dual threats to the Asian economy, undermining regional production networks. This isn't just an Asian problem. It's a problem for every country that depends on global supply chains, which is essentially every country in the world. Now let's directly compare the 2026 risk landscape with 2008, because this is where the picture becomes truly sobering. In 2008, the crisis was driven primarily by one sector, subprime mortgages. Banks had loaded up on mortgage-backed securities that were supposed to be safe but were actually filled with toxic assets. When housing prices fell, the whole house of cards collapsed. The crisis was severe, but it was also contained in the sense that the problem was identifiable and the solution, while painful, was straightforward. Clean up the bad assets, prop up the failed institutions, and restart lending. The risks in 2026 are fundamentally different. We're not facing a crisis from a single sector. We're facing potential collapse from multiple directions simultaneously. Corporate debt is at record levels. Consumer debt, including student loans and auto loans, has exploded. Commercial real estate is facing a refinancing crisis. The government itself is drowning in debt. The AI bubble could burst at any moment. And the shadow banking system has grown so large that a crisis there could dwarf what we saw in 2008. The Federal Reserve's own hypothetical severely adverse scenario for 2026, used in bank stress tests, assumes a sudden loss of risk appetite U.S. Equities falling 54%, the VIX spiking to 72, corporate spreads widening by approximately 570 basis points. These dynamics are even more extreme than those experienced in 2008. Under that scenario, GDP would fall sharply, projected at roughly 4.8% peak to trough, comparable to the 4.3% decline in 2008 to 2009. Unemployment would soar from roughly 4.5% to 10%, matching the peak experience in 2009. Commercial real estate values would collapse, with housing falling 29% and office properties falling 40%, far exceeding the losses experienced in 2008 to 2009. The damage would be widespread and severe. It's one thing to look at the data, it's another to hear what the experts are saying. And the warnings are getting increasingly dire. Aaron Lockwood, a political scientist at UC Irvine who studies financial crises, cautions that while a crisis may not be imminent, the ingredients are certainly there. She highlights parallels to 2008, warning that highly correlated defaults could trigger cascades of risk models fail, leaving highly leveraged firms without the liquidity to make good on their debts. In her view, the combination of big deficits, tariffs, deregulation, and asset bubbles in AI and crypto have set off alarm bells. Nouriel Roubini, the economist who correctly predicted the 2008 crisis, offers a more upbeat baseline. He sees only a short, shallow downturn in 2026, followed by a strong rebound and easing inflation. He argues that if controlled policy shifts boost investment, especially in tech, and inflation falls, the recovery could start in late 2026. Roubini's view suggests mild recession risk rather than a full-blown crisis. But even Wall Street forecasters who aren't doomsayers are expressing concern. JP Morgan's 2026 outlook puts U.S. recession odds around 1 in 3, largely due to fading labor market strength and political risk. Analysts at Schwab and Bank of America note that the biggest immediate worry is a tech or AI bubble and trade unpredictability, not credit. And then there's Jamie Dimon, JP Morgan's CEO, who warned of more hidden cockroaches in the economy. This is the kind of language that markets pay attention to because Dimon has been right before. I want to be fair here. Not every economist agrees that a 2026 crisis is inevitable or that it would be worse than 2008. There are scenarios where things work out. Goldman Sachs research forecasts 11% returns for global stocks over the next 12 months, suggesting that markets could continue climbing in 2026. Some analysts argue that inflation will continue to moderate, allowing the Federal Reserve to cut rates more aggressively, stimulating growth without reigniting inflation. The private credit market, despite its risks, has attracted sophisticated investors who understand the need for yield in a low interest rate environment. If the economy avoids recession, most borrowers will continue to service their debts and private credit funds will perform as promised. And the United States has demonstrated remarkable economic resilience over the past several decades. The ability to innovate, to adapt, and to recover from shocks is baked into the economic DNA. A soft landing, where inflation returns to target without a recession, remains a possibility. But hope is not a strategy. And the purpose of this analysis is not to predict the future with certainty, but to assess risks and prepare for contingencies. The question isn't whether a crisis will happen. The question is whether we're prepared for one if it does. So where does this leave us? The United States faces a convergence of risk unlike anything seen since the Great Depression. The national debt has reached unsustainable levels, with interest payments consuming an ever larger share of the federal budget. Inflation remains sticky, trapping the Federal Reserve in an impossible position. A massive wave of refinancing is approaching, and foreign demand for U.S. Treasuries is weakening. The AI bubble could burst at any moment. The shadow banking system has grown beyond the reach of regulators, and the dollar's position as the world's reserve currency is under assault. Compared to 2008, the economy today is more leveraged, more fragile, and more vulnerable to cascading failures. The tools that policymakers used to fight the last crisis, particularly fiscal stimulus and monetary easing, are largely exhausted. The federal government simply doesn't have the fiscal space it had in 2008, and the Federal Reserve has already cut rates multiple times. The geopolitical environment is more volatile, with multiple conflicts heating up and trade tensions simmering. The political system is more dysfunctional, with government shutdowns and debt ceiling crises becoming routine, and the complexity of the financial system has increased, with shadow banking activities that regulators still don't fully understand. All of this adds up to a situation where a crisis, if it comes, could be more severe and harder to contain than what we experienced in 2008. The ingredients are there, the warning signs are there, and more experts are pointing to them. The question now is whether policymakers, investors, and ordinary citizens will take these warnings seriously before it's too late. History suggests that they won't. Complacency has a way of winning over caution, especially when the warning bells are ringing and markets are still going up. But knowledge is power, and now you know. You know the risks, you know the numbers. You know what experts are saying? And you can make informed decisions about your own financial future. Stay vigilant, stay informed, and above all, stay prepared. Because the storm clouds gathering on the economic horizon are real, and they're getting closer. Thank you for watching. Until next time, this has been your economic analyst, bringing you the stories that matter, even when they're hard to hear. Good night, and good luck.